This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. The January jobs report, released 2 weeks ago, showed the economy added 130,000 jobs, beating expectations and offering hope that the labor market was finally stabilizing after a dismal 2025. But that report also included a massive downward revision, showing nearly 900,000 fewer jobs were created last year than originally reported. Monthly job gains in 2025 averaged just 15,000, far below what's needed to keep up with population growth. By mid-February, economists were calling it a hiring recession. Companies weren't firing en masse, but they also weren't hiring. Workers were stuck in limbo with little leverage to negotiate raises and longer job searches if they tried switching roles. Meanwhile, layoff announcements in January hit their highest level since 2009, setting the stage for a tense February. On Thursday, February 19th, the Department of Labor reported that initial jobless claims fell by 23,000 to just 206,000 for the week ending February 14th. That's well below market expectations of 225,000 and marks the lowest reading in 9 weeks. The 4-week moving average dropped to 219,000, down from 220,000 the prior week. Continuing claims, which track people still collecting unemployment benefits, rose slightly by 17,000 to 1.87 million for the week ending February 7th. The insured unemployment rate held steady at 1.2%. These numbers suggest that despite all the headlines about layoffs, most workers who have jobs are keeping them. Employers aren't aggressively firing, but they're also not hiring. Beneath the surface, the tech sector tells a different story. So far in 2026, over 112 tech companies have laid off more than 40,000 workers, averaging 787 people per day. Amazon cut around 16,000 jobs in January and another 2,200 in early February. Meta laid off 1,500 employees from its Reality Labs division as it shifts investment from the metaverse to AI-enabled wearables. Oracle is reportedly planning to lay off as many as 30,000 employees and sell its health tech unit Cerner. Salesforce, Block, Autodesk, and dozens of smaller companies have all announced cuts. Globally, nearly 245,000 tech jobs were eliminated in 2025, with about 70% coming from U.S.-headquartered companies. AI was cited as the cause of nearly 55,000 layoffs in the U.S. last year. In 2026, that trend is accelerating. A recent survey found that 55% of U.S. hiring managers expect layoffs this year, and 44% anticipate AI will be a top driver. The layoffs aren't limited to entry-level or support roles. Senior positions and specialized technical roles are being cut as companies redesign teams around automation and artificial intelligence systems. Employers are prioritizing candidates with AI expertise while reducing roles tied to routine corporate processes. Geographic data shows job losses remain concentrated in established tech hubs. Seattle leads worldwide layoffs by city with more than 16,500 workers affected, largely reflecting reductions at Amazon and other Seattle-headquartered companies. The labor market is caught in a strange paradox. Low jobless claims suggest stability. If you have a job, you're likely keeping it. But tech layoffs and the hiring freeze mean finding a new job is harder than it's been in years. Economists are calling this a jobless expansion. The economy isn't collapsing, but it's not creating enough jobs to absorb new workers entering the labor force. With the Trump administration's immigration policies reducing population growth and the massive baby boomer generation retiring, the break-even rate for job creation is now very close to zero or potentially negative. That means the economy doesn't need to add many jobs to keep unemployment steady. At the same time, demand for workers has softened, giving employers the upper hand and putting a squeeze on wage gains. Average wages in January were up just 3.7% year-over-year, down from 3.8% in December. That's barely ahead of inflation and far below the 5 to 6% gains workers enjoyed in 2022 and early 2023. The trend is fragile stability, not recovery, not collapse, just a slow grind. If you're employed and not in tech, Your paycheck is probably stable for now, but don't expect a raise. With labor supply exceeding demand, you have little leverage to negotiate higher wages. If you're looking to switch jobs, expect longer search times and fewer opportunities. Job postings remain far below the number of unemployed people looking for work. If you work in tech, retail, or transportation, layoff risk is elevated. Companies cite AI implementation, cost-cutting, and economic uncertainty as reasons for cuts. If you're in healthcare, demand remains strong. That sector continues driving nearly all job growth. Overall, job security feels shakier than headline unemployment numbers suggest. Income loss is a big worry for lots of families. Even for those who keep their jobs, thinner wallets from stagnant wage growth combined with still high costs create affordability pressure. The combination of a frozen hiring market and ongoing layoffs means workers have lost bargaining power. That dynamic could land especially heavy in kitchen table discussions already bogged down by affordability concerns. The February jobs report is scheduled for release on Friday, March 6th at 8:30 a.m. Eastern Time. That will be the first major test of whether January's hiring pickup was real or a one-time blip. Before that, watch for weekly jobless claims data released every Thursday, and pay attention to any additional layoff announcements from major companies. If layoff plans continue accelerating and February hiring disappoints, the job market's fragile stability could crack. Also watch whether healthcare continues carrying all the weight, or if other sectors finally start hiring again. If tech layoffs keep climbing and spread to other industries, the jobless expansion could turn into something worse. The next few weeks will determine whether 2026 brings stabilization or further deterioration. For now, the safest bet is to hold tight, build emergency savings, and avoid making career moves unless absolutely necessary. This is not a job market that rewards risk-taking. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with the updates that matter. Until then, stay informed and protect your wallet.